Okay, Mukesh Patel here. Let's talk about financial and tax considerations for your company. So there's a few things to be aware here, and you should absolutely consult with a respected, credentialed tax expert, whether it's a CPA or tax counsel or tax attorney, to make sure that you're taking advantage of all the tax considerations and you're not going to be blindsided by tax considerations. Some of the things you should ask your tax counsel and make sure you understand will include things like qualified small business stock, QSBS. It's a very important consideration that can save you a significant amount of money from a tax point of view. Also, extremely important, ask your tax counsel or attorney about the 83B tax election. This is for restricted stock grants. So if you as founders or your employees, advisors are issued restricted stock, which is often a preferred way of stock issuance, then the recipient has an opportunity to file an 83B tax election. We'll go into that detail a little bit later. And certain states, many states, offer advantages and perks and benefits. If you are in that state creating jobs, helping with economic development and employment, you can often get a tax credit from the state, such as in the state of New Jersey, something called the New Jersey Angel Investor Tax Credit. Remember, this is for educational purposes only. We are not giving legal or tax or financial advice or investment advice. This is to help founders be better suited, better prepared, and have business acumen so that they have the right questions to ask their attorneys. So let's quickly look at what a qualified small business stock, QSBS, tax consideration is. It's promulgated under the Internal Revenue Code. It is for an active domestic, meaning U.S. C Corp, with assets of less than $50 million, less than or equal to $50 million, on or after issuance of the stock, which might be most startups. If the firm is in certain industry sectors like technology, retail, wholesale, and manufacturing sectors, they might be eligible. You have to look at the details to see if your industry sector could qualify. It's applicable for any stock acquired after 1993, and basically capital gains from QSBSs are exempt from federal taxes. That's a huge tax advantage. There is an exclusion cap greater of $10 million or 10x the adjusted basis of the stock. Some of this language gets a little fancy. Make sure you consult proper counsel to understand this and that they have your back on this. But essentially, gains above the cap would be subject to capital gains tax. But within those caps, it could be tax exempt from federal tax. The investor cannot be a corporation, so they should be individuals or perhaps other types of entities that are investors in your company. And the investor has purchased your stock with cash or property or accepted it as payment for service, like maybe some advisors or consultants, for example. And if the recipient of the stock holds the stock for at least 5 years and a few other restrictions, then you can take advantage of QSBS. So let's look at an example. An investor invests $1.5 million in a tech startup in October 2010 and holds that investment for 5+ years. They can sell that investment for up to $16.5 million, which is 10x their original investment of 1.5, without owing any capital gains tax. So once they deduct their initial investment, they have a $15 million capital gain, none of which might be taxable on the federal income tax level. Let's look at another example. An investor invests $500,000. They'd be able to sell their shares for up to $10.5 million, $10 million plus the $500,000 initial investment, with no tax on the capital gains of $10 million. However, if the investor proceeds from the sale are $20 million, then there might be a capital gains tax applied to the additional $10 million gain. But the initial $10 million could be exempt from federal income tax. The 83B tax election is a little bit different. So this is an option to pay taxes on the fair market value of the restricted stock at the time of granting the stock, so when you receive it. It applies to equity that is subject to vesting. Vesting typically involves some form of risk of forfeiture, so that if you terminate your employment or leave the company or violate the requirements for the stock vesting, then you could lose the vesting. So this allows recipients of restricted stock to prepay their tax liability when the valuation of the stock is low. The assumption is that the equity value will increase over time, so there is a huge benefit in doing this. This election essentially gives the co-founders or recipients the option to pay taxes on the equity up front before the vesting period starts. So many startup companies will grant stock at an initial par value of very small dollar amount per share, sometimes 0.0001 cent per share. Keep in mind that there is a strict deadline to file this 83B tax election. It's 30 days from the date of the stock grant. So you pay the tax on the difference between the value of your investment, which ideally might be extremely nominal, and what you paid for it. That difference, you pay the tax that year when you receive the stock, and then let it grow in valuation over time with the tax advantage. So the New Jersey angel investment tax credit is another benefit if you are incorporated anywhere but essentially doing business in New Jersey. So 20% of the qualified investment made in a New Jersey emerging tech company, and that 20% could go up to 25% if the business is certified to be minority or women business enterprise, or it's part of an opportunity zone. You can get higher than 20% tax advantage or tax credit. The benefit is that this credits against the corporation business or gross income tax. So it stimulates investment in New Jersey tech sector businesses. And the New Jersey emerging tech business must employ fewer than 225 employees, at least 3/4 of whom work in New Jersey. There may be other eligibility requirements, so you should do this more research or talk to your legal counsel or tax counsel to assist. But it could help you get angel investors interested in investing in your company, because they will get this additional tax benefit. In the next module, we'll talk about legal agreements and forms and contracts.